Let me ask you something. What is one stock that everyone tells you to buy for AI? It's Nvidia, right? Every single time without fail. And look, Nvidia is a great company, but great company and great investment are two very different things. When every retail investor on the planet is chasing the same ticker symbol, the edge is gone. And the investors that are quietly making real money aren't buying the chip, they're buying what the chip needs to survive. So here's the reality. Data center power demand is up by 40% by 2030. Utilities are spending $1.3 trillion just to keep up. Grid equipment lead times have blown out to over 100 weeks. And Microsoft and Amazon are so desperate for electricity, they're actually cutting nuclear deals directly with the plant operators to bypass the grid entirely. Yeah, really. So in this video, I'm going to share 4 predictions about the next phase of AI infrastructure build-out and a stock poised to potentially benefit from each one. Hi, I'm Jacob Wade. I'm a financial coach for high-income earners. And if you like market prediction videos like this, just hit the like button below for me so I know to make more deep dives just like this. Now, I do have to tell you this video is for educational purposes only. It is not personalized to your situation, so consult a licensed financial professional before investing. All right, prediction number 1, the AI power crisis is going to force the largest upgrade to the American electrical grid since the New Deal. And the companies that physically build out that grid are going to get paid enormously to do it. Here's the scale. $1.3 trillion in committed utility capex through 2030. Data centers consuming 40% more power by the decade's end. Grid equipment lead times are blown out to over 100 weeks. That means transformers, switchgear, the hardware that actually moves electricity. You don't order it and wait for shipping. You wait nearly 2 years to get that upgrade. So the bottleneck isn't actually money. The money's there and available. The bottleneck is the labor and the execution. Boots on the ground, crews that actually know how to build this stuff. That is an extraordinarily powerful position to be in right now. So the company, the stock that puts you in the middle of that opportunity is MYR Group, ticker symbol MYRG. They don't make software, they don't make chips, they string together transmission lines. They build substations. They do the unglamorous yet essential physical work of expanding the electrical grid. And right now, that work is in higher demand than at any point in this company's history. And the numbers actually back this up. So revenue recently hit $3.8 billion over the trailing 12 months. Earnings are up 318% year over year. Not 3%, not 30. I'm saying 318% year over year. The 3-year earnings growth is compounding at nearly 92% annually, and the 10-year earnings growth is over 737%. All while the rest of the market chases semiconductors. Yay. And the stock's price does reflect this. It's up 185% over the past year alone, and up 70% in just the last 3 months. But analysts and the Zen Ratings suggest that there's still runway for more. Now, what does Wall Street think about all this? Well, 5 analysts cover MYRG, and 4 rate it a strong buy, and there's 1 person that says hold. Now, the current max forecast comes from Manish A. Samaya of Cantor Fitzgerald, who believes the stock could see 20% or higher upside even from current levels. And crucially here, the Zen Rating quant model lands it in the same place as a strong buy. Now, Zen Ratings is our proprietary system that runs 115 fundamental checks and distills them into a single letter grade, and MYRG earns an overall A grade, a strong buy. Now, looking at the component grades that actually shape this overall rating, growth is an A, and it's backed by those earnings explosion numbers. And financials also come in at an A, which is crucial. The balance sheet is solid, and the company isn't taking on reckless debt to fund this expansion. Now, momentum is at a B, sentiment is at a B, safety is at a B, and the one softer grade is value at a C, which leads directly into a risk worth knowing about. Now, after nearly a 200% run over the past year, MYRG is not cheap. The price to earnings sits above 50 times earnings, and the fair value estimate puts the stock below where it's currently trading. So if you are buying here, you are paying for future growth. Now, if for some reason that growth stalls, if the utility spending gets delayed or the company hits execution issues on those large contracts, the stock could pull back hard and fast. But here's the thing, is that backlog of work in electrical construction is measured in years, not quarters. The contracts being signed today to rebuild the grid for AI power demand lock in revenue well into the future. So MYRG isn't just riding a hype cycle, it's riding a capex cycle, and that's a much more durable thing. The money is already allocated, the work just has to get done. Now, if you're getting any value out of this video and don't want to miss any future timely market predictions, hit the subscribe button below. And if you hit that notification bell, you'll be notified every time we drop a new video. All right, now let's move on to prediction number 2. Everyone is talking about the power problem, but nobody's talking about the heat problem, and they're actually the same problem. Here's what I mean. An Nvidia Blackwell GPU rack can draw over 100 kilowatts of power. That electricity doesn't just get used, it becomes heat. Enormous, concentrated, facility destroying heat. And the data centers running these AI workloads have to move that heat somewhere or the whole operation shuts down. So air cooling, the old solution, is already hitting its physical limits. So the industry is rapidly shifting to liquid cooling, pumping chilled water directly to those chips. And that shift is actually happening right now at scale across every major hyperscaler on the planet. The liquid cooling market is projected to grow at over 25% annually through the end of the decade. That's not just niche, that's a mega trend hiding inside a mega trend. Now, the company that sits at the center of all this opportunity is Gorman-Rupp, ticker symbol GRC. Now, Gorman-Rupp has been making industrial pumps since 1933. We're talking water, wastewater, HVAC, fire protection. And I bet you've never heard them pitched as an AI stock until now, and that's exactly the point and the opportunity. GRC is already embedded into the cooling and water management infrastructure that data centers depend on, and that demand is quickly accelerating. Revenue hit $695 million over the trailing 12 months, and they're up 32% year over year. Earnings is also up 32.5%. And if you zoom out 3 years, it gets even more interesting. 168% compound earnings growth. The stock is up 93% in the past year and still sits near its 52-week high. Now, the profit margin is at 8.4%. The 10-year earnings growth has 143%. And the Gorman family, James and Jeffrey, own over 40% of this company combined. So that's not just a management team watching from the sideline, that's generational skin in the game with this company. Now, GRC also pays a dividend that has grown consistently for 10 years, yielding just over 1% with a conservative 33% payout ratio. Has room to actually keep growing this. Now, interestingly, none of the analysts in our database cover this stock. That's surprising for a nearly $2 billion company with 93% annual returns. That coverage gap is actually part of the opportunity, though. Wall Street hasn't caught up to this stock yet. However, aggregated forecasts suggest continued earnings per share and revenue growth over the next 2 years with upward sloping projections on both lines. So the Zen Ratings gives GRC an overall A rating, a strong buy. Now, the standout grade here is sentiment, which is at an A, which reflects the institutional interest building quietly around this name. Momentum is currently at a B. The stock has been moving in the right direction. Financials are also at a B, safety is also at a B, and growth and value both come in at a grade C, which is honest. This isn't a hyper-growth name trading at a bargain price or anything. It's really a quality company that's getting a new tailwind behind it. Now, the risk with GRC is that the liquid cooling connection is kind of indirect. Gorman-Rupp doesn't sell exclusively to data centers. They serve construction, agriculture, municipal water, and a dozen other end markets. Now, if the data center cooling thesis actually drives the stock higher, but GRC's actual exposure is more modest than the narratives suggest, then the valuation could get ahead of the actual fundamentals of the company. And at a price to earnings of nearly 34 times earnings, there is not a lot of cushion for disappointment here. So that is the risk. But here's the thing. GRC doesn't need data centers to be its only customer to win. The broader infrastructure spending surge, right? Utilities, municipal water, construction, hits almost every market that they serve simultaneously. So really, AI cooling is just the new tailwind on top of an already strengthening business. And if you add in family ownership above 40%, a decade of dividend growth, and 3 years of accelerated earnings, you have a company with serious quality characteristics that most investors simply haven't found yet. By the way, if you're looking for more stock market analysis, Wall Street Zen's editor-in-chief Steve Reitmeister does live market analysis every Monday at 7 p.m. Eastern Time, and you can join him for free. Every week, he walks through not just what he's buying and watching, but exactly how he's finding these opportunities so you can replicate the process yourself. He also shares his handpicked stock of the week, where he combines the power of the Zen Ratings model with over 40 years of investing experience to find ideas you won't hear anywhere else. It's called the Wall Street Zen Live Training Session. It's completely free and it's coming Monday at 7 p.m. Eastern Time. So you can sign up at wallstreetzen.com/live. There's also a link in the description below, or you can just scan the QR code on the screen right now. All right, prediction number 3. Every data center that gets built has to be built by somebody, right? The chips are designed in Silicon Valley. They're manufactured in Taiwan. But the actual physical facility, the electrical systems, the HVAC, the mechanical infrastructure that keeps a 100,000 square foot building running at the temperatures AI workloads demand, that work is done by specialty contractors. And the pipeline of that work is actually unlike anything the construction industry has ever seen. Microsoft alone has committed over $80 billion, with a B, dollars in data center infrastructure spending in 2026 alone. So Amazon, Google, Meta, all running similar numbers. So every single one of those facilities needs to be wired, cooled, and mechanically commissioned before a single GPU can even go online. The construction backlog for data center buildout is measured in years. And the contractors who do this specialized work have pricing power right now that they have never had before. And this is one of the most direct, tangible, no-hype ways to own the AI infrastructure boom, and almost nobody's talking about it. And the company that puts you right in the middle of that opportunity is Comfort Systems USA, ticker symbol FIX, or FIX. Fitting, right? Now, Comfort Systems provides mechanical, electrical, and HVAC installation for commercial and industrial buildings. Their fastest growing segment right now is data centers, not a surprise. And they don't just maintain these facilities, they actually build them from the inside out. And business has never been better. Revenue hit $10.1 billion over the trailing 12 months, up 38% from a year ago. And 3-year revenue growth is over 108%. Earnings came in at $1.2 billion, up 107.5% in a single year, and 3-year compounded earnings growth is 168%. And if you zoom out to 10 years, FIX has grown earnings by over 2,300%. No, that's not a typo. 2,300% growth over a decade. And honestly, the best number here is the profit margin, which is running at 12.1%, which is honestly exceptional for a contractor. Now, the stock is up over 300% in the last year alone. Now, 5 different analysts cover FIX, and all 5 rate it as a strong buy. All of them. 0 sells, 0 holds, just buy, buy, buy. And here's the twist here. FIX is currently trading above every single analyst target on the street. The stock has literally outrun the most optimistic projections that Wall Street had for it. This could create an advantageous entry point, as re-rating will likely cause a flurry of new activity and attention. Now, the Zen Ratings model gives it a B, or a buy rating. The standout grades are momentum, which is at an A, sentiment, which is also at an A, and financials, which is very important, is also at an A. So that's 3 A grades across the most forward-looking components of the model. Now, growth comes in at a B, well supported by those earnings numbers, and the softer grades are value at a C and safety at a C, which leads directly into the risk itself. FIX is trading at nearly 60 times earning, with a price-to-book ratio over 25. By any traditional valuation metric, this stock is expensive, and it has already blown past what analysts thought was a ceiling. So when a stock is priced for perfection and trading above every analyst target, any stumble in earnings or project delay, any margin compression from the labor costs, that can create a violent correction in the price. But consider what you're actually buying here. It's a company with 12% net margins in construction, which is an industry where 5% is considered pretty solid. A company that's growing revenue at nearly double the rate of its entire industry. So yes, FIX isn't a cheap stock. But the work is already contracted. The revenue is already coming in. Every new data center announcement from Microsoft, Amazon, or Google adds another project to the pipeline that this company is uniquely positioned to execute on. And sometimes a stock trades above analyst targets because simply the analysts were wrong about how big the opportunity actually was. All right, and prediction number 4, and this one is the big one. Here's a question that nobody is asking. What happens when the AI data center boom runs into a power grid that wasn't built to support it? Well, we already have the answer, right? Grid operators are warning demand is going to outpace supply. As I said, Microsoft and Amazon are signing direct nuclear power purchase agreements, bypassing the grid entirely because there's no way they can afford for their data centers to go dark. But nuclear deals take years to come online. In the meantime, every data center needs backup power for when the grid fails, not if, when. Because again, we're talking about facilities running hundreds of millions in GPU compute. A single hour of downtime at a hyperscale data center can literally cost millions of dollars. These companies will pay whatever it takes to guarantee uptime. And demand for industrial scale backup power generation is just beginning to accelerate. Now, here's a company that nobody has reframed as an AI infrastructure play: GNRC Holdings, ticker symbol GNRC. Well, GNRC makes generators. Makes sense? The home standby units, right? The brand your neighbor bought when the power went out. But that's not the GNRC that matters here. The GNRC that matters is actually quietly pivoting into commercial and industrial power generation, the heavy-duty systems that keep data centers and critical infrastructure running when the grid goes down. Now, I'm going to be straight with you because the story here is different from the other 3 stocks on this list. Revenue for GNRC over the trailing 12 months came in at $4.3 billion and earnings at $189 million. Both are down significantly from their peak. Earnings are down 44% year over year, and the 3-year trend is negative. The company had a massive pandemic boom. Everyone panic bought generators, and then they spent years working through that hangover as demand normalized. But the stock is up 107% over the past year. It ran from a 52-week low of $118 to around $270 today. The market is not looking at where GNRC has been, it's looking at where it's going. And where it's going is directly into the largest structural demand shift for backup power generation in modern history. No, that is not an exaggeration. And the 10 years earnings growth is still 221%. It's a proven business model that just hit a cyclical wall and is now being handed a tailwind that it never expected. Now, 12 different analysts cover GNC. That's the most of any stock on this list. 8 rate it as a strong buy, 2 more say to buy, and 0 people say to sell. That's 83% of covering analysts telling you this is a buy right now. Now, George Giannaikis of Canaccord Genuity is ranked in the top 7% of analysts in our system based on stock picking performance. He's got a great track record. Recently, they raised their target to $325 a share, representing a 20% upside from the current levels. The Zen Rating quant model lands on a strong buy, agreeing with the analyst consensus. So Zen Ratings gives GNRC an overall A, again, a strong buy. The growth grade itself is at an A, which might surprise you given the declining recent earnings, but the model is forward-looking at the trajectory of the business, not backward-looking at that pandemic hangover they just came from. Momentum is also at a B, financials are at a B, safety is at a B, which is great. And the softer grades are value at a C, and sentiment is at a C, again, suggesting that the market hasn't fully embraced this AI reframing of this company yet. Now, I'll say one thing to keep in mind is that GNRC is in transition. Earnings are still recovering from the pandemic hangover, and at 82x earnings, the valuation assumes the commercial pivot executes cleanly. It's also worth noting that the CEO has done some selling recently, though the board has been buying. Something to watch. Not a deal breaker, but just keep an eye on it. But ultimately, you need to step back and look at what you're actually betting on. The AI build-out requires power. The grid cannot reliably deliver it. Every data center needs backup, and GNRC is the dominant brand in power generation with the commercial product line to serve that market exactly. And yes, earnings have been hurt, but the pandemic boom was a one-time event. The AI power crisis is structural, a decade-long shift in how much reliable power the economy needs and how little the grid can actually guarantee it. That's not a tailwind. That's a whole new chapter in power generation. And GNRC is perfectly positioned to write that chapter. So there you have it. That's 4 stocks that I believe could benefit from the next wave of the AI revolution. What do you think? Let me know if there's a ticker you think should have been on this list. And while you're here educating yourself on market trends, I strongly recommend you watch my gold predictions video. Check it out on the screen right now. Thanks for watching, and I will see you in the next one.